If I had $10,000 and was starting from scratch today in Canada, here's the exact step-by-step plan I'd follow: accounts, ETFs, and order of operations. This isn't just theory, it's a practical roadmap designed for anyone living in Canada looking to make their first significant investment move. We're going to cut through the jargon and get straight to what matters, setting you up for success in 2026 and beyond. Get ready to understand the essentials, avoid common pitfalls, and confidently build a solid financial future, all starting with that crucial initial $10,000. Let's dive into making your money work smarter for you. Before we even think about investing, there are two non-negotiable financial steps every Canadian beginner must take. First, tackle any high-interest debt. Credit card debt, for example, often comes with interest rates that far outpace any realistic investment returns. Paying this off is essentially a guaranteed, high-return investment in itself. Second, establish a robust emergency fund. This should be 3 to 6 months' worth of essential living expenses, safely tucked away in an accessible savings account. This fund acts as your financial safety net, preventing you from having to dip into your investments during unexpected life events. Without these foundations, your investment journey will be built on shaky ground. Once your financial foundation is solid, the next step is to clearly define your investment goals. What are you actually saving and investing for? Are you planning for a down payment on a house in 3 to 5 years, or is this money earmarked for a long-term goal like retirement, decades away? Your specific goals will directly dictate your investment timeline and, consequently, your acceptable level of risk. Short-term goals typically require lower-risk strategies, while long-term objectives allow for more aggressive, growth-oriented investments. Without clear goals, your investment strategy lacks direction and purpose. Take the time to envision what you want your money to achieve for you. For Canadian investors, the choice of investment account is paramount due to our unique tax system. You'll primarily encounter 3 types: the tax-free savings account, TFSA, the registered retirement savings plan, RRSP, and non-registered accounts. Each serves a different purpose and offers distinct tax benefits. A TFSA allows your investments to grow completely tax-free, including withdrawals. An RRSP provides an immediate tax deduction for contributions and tax-deferred growth until retirement. Non-registered accounts offer flexibility but are subject to annual taxation on capital gains and dividends. Understanding which account suits your current financial situation and future goals is crucial for maximizing your returns and minimizing your tax burden. We'll delve deeper into the TFSA and RRSP next. For most Canadian beginners, the tax-free savings account, or TFSA, should be your very first stop. The name is a bit misleading. It's not just for savings, but for investments. The incredible benefit of a TFSA is that all investment income, capital gains, dividends, and interest grows completely tax-free, and all withdrawals are also tax-free, at any age, for any purpose. This makes it a powerful tool for both short-term savings and long-term investing. Contribution room accumulates yearly, and unused room carries forward indefinitely. With your $10,000, maxing out your available TFSA room is often the most strategic move, as it ensures all your gains are shielded from the taxman. While the TFSA is often the beginner's best friend, the Registered Retirement Savings Plan, or RRSP, is another crucial account, especially as your income grows. The primary advantage of an RRSP is that your contributions are tax-deductible. This means you get a tax refund in the year you contribute, effectively reducing your current taxable income. The investments then grow tax-deferred until you withdraw them in retirement, at which point they are taxed as income. This is generally most beneficial for those in higher income brackets, as they can save more on taxes now and potentially withdraw funds in retirement when they are in a lower tax bracket. With $10,000, if you anticipate your income will be significantly higher later in your career, you might consider using some RRSP room, but for most beginners, TFSA usually comes first. Now that you know which account type you'll be using, where do you actually open it? You'll need an investment brokerage. In Canada, several excellent options cater to different needs. Wealthsimple Trade is incredibly user-friendly, offers commission-free trading on Canadian and US stocks and ETFs, and is a fantastic choice for true beginners. K's Trade offers a wider range of investment products, lower fees for options trading, and allows free ETF purchases, making it popular for those who might want more advanced features later. Interactive Brokers, IBKR, is for the more advanced investor, offering highly competitive pricing and access to global markets. For your initial $10,000 as a beginner, Wealthsimple Trade or K's Trade are likely your best bets due to their accessibility and low costs. Compare their interfaces and fee structures to find your best fit. With your account open, what should you actually buy? For a Canadian beginner with $10,000, my unequivocal recommendation is exchange-traded funds, or ETFs. Think of an ETF as a basket of many different stocks or bonds. When you buy one share of an ETF, you're instantly diversified across potentially hundreds or thousands of underlying companies. This drastically reduces your risk compared to buying individual stocks. ETFs are also typically very low cost, with tiny management fees. They are designed to track market indices, meaning you don't need to pick winners, you just invest in the entire market. This simplicity, diversification, and low cost make ETFs the ideal investment vehicle for starting your journey, especially with a modest initial capital. To make things even simpler, Canadian providers like Vanguard and iShares have created all-in-one ETFs. These funds are literally a complete, globally diversified portfolio in a single ticker. They hold thousands of stocks and bonds from around the world, automatically rebalance themselves to maintain a consistent asset allocation, and have incredibly low management fees. Popular options include VGRO and XGRO, which hold approximately 80% stocks and 20% bonds, for a growth-oriented portfolio, or XEQT and VEQT, which are 100% stocks, for maximum equity exposure. For your $10,000, picking just one of these and consistently adding to it is a powerful strategy. You get instant diversification without the need for complex decision-making or constant monitoring. Choosing between VGRO and XEQT, or their Vanguard equivalents, VBAL and VEQT, comes down to your personal risk tolerance. VGRO, or XGRO, is an 80-20 fund, meaning 80% stocks and 20% bonds. The bonds provide a cushion during market downturns, reducing volatility, but also slightly moderating overall returns. It's a great choice for those who want strong growth but prefer a slightly smoother ride. XEQT, or VEQT, on the other hand, is a 100% equity fund, meaning 100% stocks and 0% bonds. It offers the potential for higher long-term returns but also comes with higher volatility and larger swings during market corrections. As a beginner, it's crucial to be honest about how much market fluctuation you can comfortably endure without panicking and selling. Don't chase returns, choose the fund that lets you sleep at night. Let's put it all together into an actionable plan for your $10,000. Step 1. Open a TFSA account with your chosen brokerage, likely Wealthsimple Trade or K's Trade. This process is usually straightforward and can be done online. Step 2. Transfer your $10,000 from your bank account into your new TFSA. Be mindful of your available TFSA contribution room to avoid penalties. If you don't have $10,000 of room, invest up to your limit and hold the rest in a high-interest savings account until you gain more room next year. Step 3. Once the funds settle, which can take a few business days, use the money to purchase shares of your chosen all-in-one ETF, whether that's VGRO, XEQT, or another suitable option. Remember, buying ETFs is commission-free on many platforms. Investing isn't a one-time event, it's a continuous journey. After your initial $10,000 investment, the most powerful thing you can do is set up automated, regular contributions. Even if it's just $50 or $100 every 2 weeks, this consistent habit harnesses the power of dollar-cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high, smoothing out your average purchase price over time and reducing the impact of market volatility. This disciplined approach eliminates emotional decision-making and ensures you stay on track, building wealth steadily over decades. Consistency, more than market timing, is the secret sauce to successful long-term investing. Understanding your personal risk tolerance is fundamental to building a sustainable investment portfolio. It's not just about what kind of risk you can take, but also what kind of risk you can emotionally handle. Are you the type of person who would panic and sell if your $10,000 dropped by 20% in a market correction? Or can you view it as a buying opportunity and stay the course? Your financial goals, investment timeline, and even your personality all play a role. If you're investing for retirement 30 years away, you have a high capacity for risk, even if your emotional tolerance is lower. Be honest with yourself and choose an ETF like VGRO or XEQT that aligns with both your capacity and willingness to take on risk. This self-awareness prevents costly mistakes during volatile periods. One of the often overlooked but crucial aspects of investing is rebalancing your portfolio. Over time, due to differing market performance, your initial asset allocation, for example, your 80% stocks and 20% bonds, can drift. Stocks might perform very well, making your portfolio 85% stocks and 15% bonds, increasing your risk. Rebalancing brings your portfolio back to your target allocation. The beauty of choosing an all-in-one ETF like VGRO or XEQT for your $10,000 is that this complex task is handled for you. The fund manager automatically buys and sells components within the ETF to maintain its stated allocation. This set it and forget it feature is incredibly powerful for beginners, ensuring your portfolio always aligns with your chosen risk profile without any effort on your part. While we've touched on account types, let's explicitly reiterate the tax implications. With your TFSA, any gains, dividends, or interest your $10,000 generates, and any withdrawals you make, are completely tax-free. This is an enormous advantage, especially over the long term, as you keep 100% of your earnings. With an RRSP, you get a tax break up front, and your investments grow tax-deferred, but you will pay income tax on withdrawals in retirement. For your initial $10,000, prioritizing the TFSA allows you to maximize your tax-free growth. Only consider an RRSP if you've maxed out your TFSA room or if you're certain you're in a high tax bracket now and expect to be in a lower one during retirement. Understanding these tax rules is vital for optimizing your returns. Just as important as knowing what to do is knowing what not to do with your initial $10,000. Avoid the temptation of highly speculative investments like penny stocks, options, or unproven cryptocurrencies. While these might promise quick riches, they also carry extremely high risk and are unsuitable for a beginner's foundational capital. Second, and crucially, do not panic sell during market downturns. Volatility is a normal part of investing. Remember that market corrections are often temporary. Selling low locks in your losses. Finally, resist the urge to time the market. No one can consistently predict market highs and lows. Your best strategy is consistent investing over the long term, regardless of short-term market noise. Stick to the plan, trust the process. This is where the magic happens: compound interest. Albert Einstein reportedly called it the eighth wonder of the world, and for good reason. Compound interest is simply interest earning interest on itself. When you invest your $10,000, it starts earning returns. The next year, those returns also start earning returns, and so on. Over decades, this effect leads to exponential growth, making your money work harder and harder for you without you lifting a finger. The key is time. The earlier you start, and the more consistently you contribute, the more powerful compounding becomes. That initial $10,000, combined with regular contributions, can grow into a significant sum purely because of this incredible force. Your first $10,000 is just the beginning. Once you've successfully invested this initial sum, the journey continues. Keep those automated contributions going into your TFSA until it's fully maximized. As your income grows and your TFSA room is fully utilized, then it's time to seriously consider contributing to an RRSP, especially if you anticipate being in a lower tax bracket in retirement. As your portfolio grows and your financial life evolves, it's also wise to periodically review your financial plan. Are your goals still the same? Has your risk tolerance changed? This doesn't mean fiddling with your investments constantly, but rather ensuring your strategy remains aligned with your life's trajectory. Continue to educate yourself and stay disciplined. To recap our journey for investing $10,000 as a Canadian beginner in 2026, first, solidify your financial foundation by eliminating high-interest debt and building an emergency fund. Second, identify your financial goals. Third, open a TFSA account and fund it with your capital. Fourth, invest your $10,000 into a globally diversified, low-cost all-in-one ETF like VGRO or XEQT, matching your risk tolerance. Fifth, automate future contributions and stay consistent. Finally, remember that patience and discipline are your most powerful allies. Avoid market timing and emotional selling. By following these steps, you're not just investing $10,000, you're building a foundation for long-term financial success. The most important takeaway of all is this: don't delay. The biggest barrier to investing for many beginners is simply getting started. You now have a clear, actionable plan to invest your $10,000 as a Canadian. The principles we've discussed are timeless and effective. The sooner you begin, the more time compounding has to work its magic, and the more robust your financial future will become. So, take that first step. Open that account, fund it, and make that initial purchase. Your future financial freedom starts with the decisions you make today. Good luck on your journey, and happy investing. Thank you for watching. If you liked this video, please like and subscribe.